Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today, again, we're going through some of the earnings results which would have taken place over the past couple of weeks. And today, we're going to focus on Agostini's Limited as well as WCO, or West Indian Tobacco Company Limited. Now, both companies would have had fairly different results. So let's take a look at how both groups would have performed and what investors could expect in the coming months ahead. Now, turning firstly to Agostini's Limited, or AGL, well, for the half-year period ended March 2023, the group would have recorded an earnings per share figure of $3.03, a whopping 98% improvement from the $1.53 recorded in the prior comparable period of fiscal 2022. Now, take that with a pinch of salt. There was one significant, one major one-off gain or non-cash gain, which would have uplifted the earnings per share figure. Now, on an adjusted basis, that earnings per share figure would have come in at around $1.95, which is still a very commendable 27% increase in performance over the comparable period. Now, revenues would have improved just under 14% from 2.1 to 2.4 billion, operating profits up 19.2% from 226 odd million to 217 million. Overall, net profits attributable to equity holders improved at 98% from 105 million to 209 million. But again, there was a 77 million odd gain on acquisition, which would be one-off in nature and non-recurring going forward in subsequent periods. Now, when we take a look at the profit before tax by segment for AGL, we see a continued improvement in the pharma and healthcare segment in that yellow color. For example, we can see that there was 30% growth in profits before tax, or PBT, growing from 82 to 107 million. 12% gain in consumer products, in the consumer product segment, from 113 odd million to just about 127 million. And in that energy, industrial and holding segment, well, that move was from 14 million to 91 million. But again, that would have included, to a large extent, the revaluation on, or the gain on acquisition, rather. So on an adjusted basis, it would have been fairly stable performance for that particular segment in that recently concluded period. Now, margins continue to improve for Agostini's Group Limited, which is always a good thing for any company. And we can see, looking at the operating profit margin, given that it would have not have been affected by that one-off gain, that operating profit margin in the blue segment would have, or blue column, would have improved from 10.8% to 11.3%, and continues the upward trend that has been delivered by Agostini over the past couple comparable periods. So certainly margins moving in the right direction, along with revenues, which have grown in tandem, certainly with some organic growth as well as that acquisition activity. And speaking of acquisition activity, we can see the acquisition pipeline of completed or announced acquisitions over the past couple of years for Agostini, starting with Lightsource. During 2020, then we saw the major acquisition of Oscar Francois into Sol and Roscoe Procom. In 2021, Collins Limited and Carlisle Labs as well. And we can see that the most recently announced acquisition of Chinook Trading Canada, which will take place later this year, or effective financials later this year. And we can see that commensurate growth in assets, growing from about 2.7 odd billion in 2021 to 3.7, just under 3.8 billion as at its most recently concluded period of March 2023. So certainly those acquisition activities are helping to grow Agostini's assets as well as its revenues and profits. So at a trading price of, or the last traded price of $66.42, Agostini's is trading at a price-to-earnings ratio of 15.1 times compared to the sector average of 12.1 times. So certainly a little bit above that sector average. Now, adjusting for that one-off gain, the price-to-earnings ratio of Agostini would inflate further to just under 20 times. So certainly elevated valuations when compared to the sector, with a dividend yield of 2%, which is below the sector average of 2.9%. Now, on the basis of revenue and margin growth, or continued revenue and margin growth, with those acquisition activities, of which we are fairly certain they will continue, given that it seems to be a strategic initiative of the group. But with those elevated valuations in mind, Bourse is going to maintain a market weight rating on Agostini's for the time being. Turning very quickly to West Indian Tobacco, or WCO. Well, for the first quarter of 2023, the group reported an earnings per share figure of 13 cents, which is a whopping 64% decline from the 36 cents recorded in the prior comparable period. Now, revenues, very surprisingly, would have declined just about 38% from 202 million to 125 million, with a commensurate decline in gross profits, 50% from 149 to 73.4. Overall profit for the period declined at 63% from 92 million to just about 54 million. So certainly not good reading for Whitco shareholders at this point in time. And one of those major drivers has been the ongoing revenue challenges, despite some stabilization or apparent stabilization in the first quarter of 2022, where there was actually marginal revenue growth in the first quarter of 2022 compared to 2021. We would have seen that revenue stream slip, or total revenue stream slipped 38% to that $125 million odd figure from the 202 recorded in the prior comparable period. So certainly something to keep an eye on in terms of Whitco's performance, where revenues have come under a lot of pressure from illicit products as well as substitute products over the past couple of years. Now, when we take a look at Whitco's margins, Whitco, which has traditionally been a model of efficiency, some of their margins would have deteriorated fairly pronounced measure over the past couple of periods. We can see, for example, taking a look at the operating profit margin in that teal color, it would have fallen from about 64%, which has been its recent historical average, to 37% in the most recently concluded quarter. So certainly one of the factors to keep an eye on is those declining revenues coupled with those declining margins for Whitco. Now, at a price of $13, and the stock would have adjusted fairly significantly over the past 6 months, or 6 to 12 months rather, at a price of $13, Whitco is trading at what would appear to be a relatively attractive price-to-earnings ratio of 16.1 times compared to the sector average of 31.3 times. Now, again, take that with a pinch of salt, because if earnings continue to adjust downward, that PE ratio could very quickly start to escalate, and offers a trailing dividend yield of 7.5% right now, which again, compared to the sector average currently of 3.2%, appears relatively attractive. But again, taking a forward-looking approach with the non-declaration of dividends in the most recently concluded quarter, there could be further non-declarations or reduced dividends, which could bring that dividend yield more in line with the market. So on the basis of those revenue challenges and those narrowing margins, but again, with those relatively attractive valuations under some degree of question relative to where the stock is trading right now, relative to the market, Bourse is going to maintain a market weight rating on Whitco for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com. Of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And you can catch this article in the business section of today's Trinidad and Tobago Guardian newspaper. Well, that's it for this week's edition. And we'll see you next time. Have a very safe and prosperous investing week. And take care, and we'll see you next time on the Bourse Report.